I want to talk about all of the reasons why the recession is still coming. It has not been canceled. It's just being held in abeyance, but not for much longer.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. With interest rates higher than they've been in over 20 years, many analysts and economists have expected the economy and then the financial markets to buckle under the higher cost of debt. After all, we have 6 times the total public debt as we did the last time interest rates were this high. But whether that will eventually prove true, the markets are priced as if it won't. Right now, they're priced for no recession, no adverse lag effects from the historically aggressive hiking and tightening campaign pursued over the past year and a half by the Federal Reserve and most of the other major world central banks. So, when will this higher cost of debt matter? Will it matter? For answers, we turn to the highly popular and always informed money manager and macro analyst, Michael Pento. Michael, my friend, thank you so much for joining us today.
Hey, it's always a pleasure to be on with you, Adam.
Mutual association, brother. You're one of my absolute favorite people to interview, and you are definitely, without a doubt, one of the most requested guests by the Wealthion audience. So know that you're here among friends, Michael. So lots to talk about with you. If we can, let's just start with the general question I like to ask you at the start of all our discussions. What's your current assessment of the global economy and financial markets?
Well, I think it's very clear to me through the facts that I look at every day that the recession has been delayed. It's been held in abeyance, but it's absolutely not been canceled. The soft landing narrative is a complete myth. And let's just go through some of the reasons why I believe the recession was delayed, some of the most popular ones, and then I'll get to the real one, or the most salient reason why I think the recession is delayed. 2023, we had massive deficit spending. Now, a lot of people just end the conversation with, well, you can deficit spend and that's stimulative to the economy. Well, we had massive deficits in 2000, 2001, 2002, 2008, massive deficits caused by the automatic stabilizers kicking in when you have a recession. So that's not really what I would call stimulative. And please don't forget that these massive deficits cannot continue forever to the pace and quantity that we are now experiencing, both in nominal terms and as a percentage of GDP. Because what happens when you run massive deficits, Adam? You destroy your economy. You get higher taxes, higher interest rates, higher inflation, and you destroy productivity. So let's just put that one aside. So that's one reason why it's delayed, but that can't continue. And in the long run, it really stinks. Okay, number 2, consumers and businesses locked up a tremendous amount of low interest rates, a tremendous amount of debt and a tremendous amount of low interest rates. That is true, but there's a day of reckoning coming in 2024 and 2025, and I'll talk about that in a little bit. Of course, we also hear that the consumer has a lot of excess savings. Well, that was true in 2022, just as true as it was in 2023. So what do I think is the real reason why? I think the last time you had me on was around the time on Wealthion. I think it was around the late spring when I was on, when we had these 4 banks fail. And I had predicted in 2022 that it was going to be in 2021, that 22 would be a bad year, and that 2023 we would have a recession. So why didn't it happen? I think if you want to put the nucleus out there and split that atom, it's because, no pun intended, by the way, is because we had the Bank Term Funding Program, which was a bailout of the entire U.S. financial system. That is what turned the market around. Remember, the economy and the market were turning into a ditch, going off the rails in March. Stock market started to plunge. You had spreads widen out. High yield was blowing out. Financial conditions were tightening. And then the Fed came in and monetized. And this is key. They printed $400 billion of base money supply. What is the base money supply? It's high-powered money. It's called that for a reason, because it's physical cash and Fed credit, which can be used to buy bonds and make loans and can in itself be turned into cash. They printed $400 billion in 2 freaking weeks, Adam. And that was 50% of the entire Fed's balance sheet from 1913 all the way through the end of 2008. That is why we have a recession delayed. And I want to spend, if I had my druthers, it's your show, I want to talk about all of the reasons why the recession is still coming. It has not been canceled. It's just being held in abeyance, but not for much longer.
All right. You've got a blindingly green light to do exactly just that, my friend. And we can jump right in there if you want to. I talked at the beginning about the high cost of debt that we have right now. So we have a lot more debt right now, right? You just mentioned, this 400 billion that was pumped out in 2 weeks via the BFTP. I think people kind of forget now, with the Fed balance sheet up at, I don't know what it is right now, around 8 trillion or so?
It's a little over 8 trillion, I think it's 8.3 trillion right now.
Yeah, so 8.3 trillion. So that was only 800 billion at the start of the global financial crisis in 2008, right? I mean, it has gone up more than 10 times in, what is that, right? Like 15 years or so. And that's it's mind-boggling to those of us who think of it. But I think to the average, casual observer, that's sort of, whatever, half a trillion, not even half a trillion. How could it be that bad? Well, I mean, that, as you said, was half the Fed's balance sheet just 15 years ago. Yeah. And so, as I said, I think the last time interest rates were in this territory, it was right at the turn of the millennium, right, where we had 1/6 the amount of public debt, total public debt that we have out there right now. Now, the system following the great financial crisis got very habituated, many would say addicted, to ZIRP, zero or extremely low interest rates. And now we've had this massively aggressive hiking campaign and tightening campaign. Tightening maybe hasn't been as aggressive as the hiking, but the Fed's not done yet. And people like you and me, I think, who respect math and economic history have said, look, there's a lag effect to all this that will definitely be felt, and be felt harder than in periods past because the debt is so much bigger now. But the markets don't seem to care. And a lot of people aren't that worried about it. I think they're kind of adopting this sort of like, well, I mean, it hasn't happened, so maybe it's just not going to happen. Maybe we're going to have maybe we're going to have a no landing scenario, right? So should we maybe start there with just sort of the cost of the debt?
Yeah, let's talk about, so we should know that monetary tightening works with about a year lag, maybe 16 months, about a year lag. But if you go back a year from today, what was the Fed's funds rate 1 year from today, like 1 year ago today?
I think it was under 3%.
2.5%. So if it, right now we're at 5.25 to 5.5, but a year ago it was only 2.5%. So we have a long way to go before we start to see the real teeth and the bite from these monetary hikes. We have a lot of wood to chop here before we start lapping, right? At least several months have to go by before we start lapping that 5% and above Fed funds rate. 2.5 is historically nothing. But here's something else I want to touch on. And this is very crucial to what I think you were talking about why the recession is held in abeyance and why the higher cost of money is going to mean something, especially to corporations. Of course, it means a lot to the government too, but we'll get to that later. So what I see is a corporate debt, I call it a maturity wall, going to hit in 2024 and 2025. There's $1.8 trillion worth of corporate debt that needs to be refinanced between now and the end of 2025. And the rates on that debt, Adam, are going to be between 4 and 5.5% higher than they were when they locked it in several years ago.
Yeah, and just to be clear, you don't mean 4.5% increase. You mean you're tacking on an additional 400 to 500 basis points, meaning it's like over a doubling of what they were before.
Yes. So I'm not talking about they're not going to be borrowing at 4.5%. It's going to be 4.5% higher than what they borrowed in 2020 and 2021. Okay, got it. Got it.
And sorry, just to be super clear on this for folks, when you borrow, you tend to borrow from a bank at the prime rate plus something.
Right.
And the prime rate has basically more than doubled in the time period that Michael's talking about here. So when your old debt that you've been sitting on and happy to pay low interest rates on comes up for maturity, if interest rates stay in the same ballpark they are right now, literally the cost of your debt is going to be at least 2x, probably more than that.
Yeah, exactly. And you see it already happening now. So the interest, something called an interest coverage ratio, which is basically your EBIT, earnings for interest and taxes, over your interest expense, is already falling precipitously. And that's before this great debt reset happens in 2024 and 2025. Now, you say, well, maybe we don't have to worry about that until 2025. I think that's going to start getting priced into the market very soon, as in like Q4 of this year and early in 24. Because everybody knows about this maturity. This is not, Goldman Sachs put out a report about this debt maturity wall coming. So it's coming, it's reality. And when you have 10% of companies out there as zombies, in other words, they can't even pay, they have to borrow money to pay interest on debt. That's the definition of a zombie. They don't have the cash flow from operations to pay interest on debt. What do you think is going to happen to those companies? And there's about 11 million people employed in the United States of America. 11 million people employed in these junk-rated, high-yield corporate debt businesses.
Wow, I did not know that.
A real shock.
Yeah, I did not know that stat. So we've obviously talked about the risk of zombie companies on this program before. And I guess I just sort of thought I should have thought to try to dig up that data point. But yeah, we start having, contagion amongst the zombie fleet as they are forced to go out and refinance as their existing loans come up for maturity. They're, in many cases gonna die, or on the process of dying, are gonna have to shed costs, meaning cut jobs, right? Either one of those examples is putting those 11 million jobs in jeopardy. So, this historically low unemployment rate that's super resilient and everybody points to as keeping us out of recession, that could jump pretty high pretty fast once those loans for the zombie companies start re-rating.
Not only zombies, it's like I said, high yield and junk, they're different, but the high yield companies, junk rated companies, they're not really by definition have to be zombie companies.
No, you're right.
So think about that. So let's continue on if you don't mind.
Yeah, and actually, sorry, before we do, but I just want to toss this out there because when you were talking, it reminded me of this. You remember leading up to the global financial crisis, leading up to the bursting of the housing bubble? I remember seeing these charts published by CS First Boston, Credit Suisse First Boston, and it was projecting out the amount of ARM mortgages that were going to have to come up for re-rating.
Right.
And you just saw this massive tsunami coming in the future. And guys like you and I would look at this and say, oh my gosh, there's going to be a massive reckoning in the housing market. But nobody cared.
Well, because they've been packaged into these pooled mortgages, which, housing prices have never gone down in the United States, ever, in the history of ever. So what can go wrong? Because you take a real crappy mortgage and put it in a pool of other okay mortgages, and hey, the lowest tier tranche might go bad, but that doesn't mean anything else is going to go bad. But we saw the domino effect. What happens? This is a story that's played out over and over again. What gets you in trouble is over leveraged economies. The United States is a very over leveraged economy, and there's a much, much higher interest rate on that leverage coming very, very soon.
Very, very. Okay, great. So you're underscoring my point, which is sort of like we've seen this movie before. We can see this maturity wall coming. I'll put up a chart right here while we're talking, Michael, that has come surfaced on this channel a couple of times of late, but it shows the amount of corporate debt that is coming up for maturity in the next couple of years. And I'm doing it from memory, but folks who can see the chart on the screen can see the actual numbers. But I think it was like 600 something billion this year. It goes up into the higher, getting kind of close to $1 trillion next year. 2025, it's over $1 trillion. So it is a big wave coming, but it seems like, history repeats and rhymes, right? Like we have this over leveraged system, but it seems like we still have this hubris right now that for somehow it's just not going to matter. But obviously you're saying it will.
And just to tie up a little bit of a loose end here too, I said that these banks were going to be in trouble in 2023. And how did I know that? Well, everybody was saying that what was the mollifying effect this time around was that, hey, corporations locked in very low rates forever. Mortgages have been locked in at 3%, 30-year fixed forever. Not a problem, right? No problem at all. But you learn everything has an equal and opposite reaction. For every action, it's one of the laws of thermodynamics.
Yeah.
So who owns all this debt is what I asked myself. Who owns all of this debt? Who owns the mortgage-backed securities, the commercial mortgage-backed securities, the junk debt that's yielding nothing? Well, it's banks. It's the shadow banking system. It's the Silicon Valley banks and the First Republics of the world. These are the banks that are loaded with this garbage, and their prices tanked and yields skyrocketed for this debt. And they ended up sending to the Fed through their bank term funding program all of that debt at par for a year. Now they have March, the middle of March, the Ides of March 24. We'll talk about this too. We have so much to talk about. What's Powell going to do? Now the bank term funding program is like a hybrid of the discount window. Normally, a discount window is open for about 3 months. You give your distressed debt, mostly treasuries. That's how it was intended in 1913. That's the only thing the Fed was allowed to buy. You give your underwater treasuries, your assets, to the discount window, the Federal Reserve. They give you a loan with a haircut for 3 months. The BTFP is a loan for a year at par value. But what happens at the point when we get to the middle of March 2024? Powell has to make a very big decision. Am I going to permanently monetize this debt and take it off the bank's balance sheets like QE would do? Because you're going to hand a bank or a shadow bank their treasuries and mortgage-backed securities that are a fraction of the cost, even what they were when they took them off their hands. And then the banks owe the Fed par value, full value for these assets. That's going to be a huge problem. So, again, I'm sure I'll mention this in this interview. You can't just sit there and pontificate on what you're going to do in March of 2024. A lot of this depends because the entire economy and market is artificial. The free market is dead. So we have to be on, bated breath. We are waiting on bated breath for Powell to decide what he's going to do with the bank term funding program. Is he going to roll it over, allow them to roll over this debt endlessly? And then it becomes QE.
Right.
And I would submit to you that my trading decisions will change greatly based upon what he does.
Upon his decision.
It's a big decision. And I don't hear anybody, he didn't talk about it at Jackson Hole when he went out there for his pose to look for mooses and bear. Why didn't anybody ask him, Mr. Powell, what are you going to do with the bank term funding program that's keeping all these banks afloat and alive? Anyway, I just want go ahead.
Yeah, no, these are great points. And actually, I'll try to find a chart, and if I can, I'll put it up here. But the last charts that or the most recent charts I've seen on the BFTP balance is that it's at all-time highs. So it's not trailing off like, oh, the banks are getting more stability. It's, hey, more and more people are turning to this thing, right? Which is an emergency measure, right? So that's one sign that all is not well in the banking system.
It's not that it's not well, it's getting worse. As the Fed continues to dither with its rate hikes and continuing higher, banks have assets that are yielding them 3%. And the depositors are saying, I want 5.5 because that's what I can get in a 0 to 3 month treasury, 5 and change. And the bank saying, I'm sorry, Mr. Depositor, I can't give you that because my bank would be upside down. And the depositors are taking those deposits out of the bank and going into money market funds and buying treasuries. Yeah. So the bank liquidity problem is getting worse, not better. And we haven't seen the values. We have, again, mortgage-backed security. There's commercial mortgage-backed securities that are way underwater in the shadow banking system and in the primary dealers. What are they going to do there? They haven't realized these losses yet.
Right. And sorry to interrupt, but I got to ask you to do this just for the average viewer here who might not know exactly what the shadow bank system is. Can you just very quickly name a few shadow bank players?
Any hedge fund, big hedge fund out there.
Big insurance companies, pension funds.
Insurance companies, pension funds. Yes. So they're institutions that take deposits and make loans, sort of, but they're not backed at all by any government facility. No FDIC insurance, nothing like that. Don't have access to the primary window, the primary dealer window. So
yeah, and to your point, I mean, yes, it's very important to talk about these guys, but just there's a ton of institutions out there, from pensions to college endowments to hedge funds to massive investing institutions that buy these package mortgages, right? I mean, you were joking about how all these mortgages are securitized and all these tranches. Like, these are the players that are buying all that stuff, and just like the banks, they bought all that mortgage debt when mortgage rates were at 3% or even less in certain cases, and now we're over 7.5% now. We're in that ballpark now, right? So they're sitting on massive, that is a lot of instability in the system.
Yes.
And it's amazing that some of these players haven't really blown up already. Of course, part of what's keeping them alive is some of these emergency measures, like we're talking about.
Exactly.
So let's get to Powell's decision on this then, right? Okay, so Powell is still, it's interesting. He has been very resolute in his public speech about how I'm going to keep doing what I'm doing until inflation's brought under control. By brought under control, I mean 2%, under 2%. I'm not going to raise our inflation target to 3%, like some people have been saying the Fed maybe will. So if he is that resolute, the pain could continue a lot longer than a lot of these players, would like it to, and maybe longer than they can stand. Now, what's interesting on the day that we're talking, I think a trial balloon came out yesterday. Nick Timros in the Wall Street Journal wrote a piece saying that, actually the Fed's taken a second look now at its interest rate strategy, and it's now beginning to think maybe it's done enough. Maybe it's actually been a little bit more successful than it's thought prior to this date. And so it sounds like they're trying to prepare us for, the Fed declaring mission accomplished soon.
Well, that's one of the reasons why the long end of the Treasury curve is having problems, because they're declaring victory before the war is even close to being over, in my opinion. So an early victory and an early exit off the battlefield could be extremely pernicious for the middle class of this country. To your point you just made before, nobody on CNBS or any of the mainstream financial media talks about. They talk with alacrity about how great it is that the higher rates aren't affecting the economy. They're not affecting businesses. They're not affecting consumers. They are affecting the U.S. government, in a big way. Look at the size of our deficits, the way they're exploding. And it's a lot of that is interest expense. By 2040, interest expense and entitlements will be 100% of all government revenue. So we have a big problem here, but they don't. Just to finish that thought, you don't hear about this pension plan or that insurance company or that hedge fund. There's a huge hedge fund that's loaded up with leverage on commercial mortgage-backed securities, the rates have gone through the roof, the prices are way down on these bonds, and the vacancy rates have soared. And who's are they still getting the same income stream from these mortgages? I don't think so. That's a 2024 story that has yet to be told.
Right, and they're likely not, because out where I live in the San Francisco Bay Area, we've had a number of big commercial real estate customers do jingle mail, right? Where they've said, what, I'm done, bank, here you go. You take the keys to this hotel or this high rise, right? These massive buildings, right? But even for the tenants that are still paying, there's some percentage of landlords out there that have either, variable rate mortgages, or that their debt's just coming up for maturity and they're having to borrow at a higher amount. So their profitability is suffering even if the income is staying the same. So, okay, so you've basically corroborated, my concerns in the intro, that the weight, the gravitational force of these higher interest rates are, it's just inevitable math that at some point, as long as they stay at these levels, there are going to be some pretty big breakages in the system. Now, we've been really kind of focused on the financial system and the banking system so far. You gave a quick nod to the government, but I will say one of the reasons why deficit spending is so high this year is because the cost to service the national debt, goes up in lockstep with these interest rates, right? So that is kind of eating away at what we're able to do as a government, as a society, because there's just less and less left over to do real stuff with, to actually run a country when you're sending a greater and greater percentage of it to your creditors, right? So we have that. I'd love any thoughts you want to add to the government side of things. And then maybe we can talk for a little bit too about the consumer household, because these higher interest rates matter for consumers too.
Yeah, I just wanted to, you made me laugh when you said jingle mail, because not too long ago, several weeks ago, the chief economist for Zillow came out and he said that he has this wonderful new invention called a 1% mortgage. So imagine it's not quite as bad as the ninja loans that we had in the aughts,
but it's close.
1%. And here was the piece of resistance. I'm not French. All right. The credit score to qualify for a 1% mortgage was 620. 620, which, by the way, makes them a what? A subprime borrower, Adam. So it's good to know that we learn from our mistakes.
Well, I mean, that's where I was going earlier, Michael. Clearly are not. Now, maybe these, and I think these are, like, these are signs of desperation, right? Where you're just trying to do whatever you can to keep the ship moving forward and above water. And I do not envy, some of these players in the real estate space that I think are looking around and just experiencing in real time what we're talking about. And they're just trying to do whatever they can, right? But when that article came out, I can't remember who I was interviewing that day on this channel, but I said, all right, well, let's set our watches. I think it was Stephanie Pomboy. I was like, I give it at most a year before we see the headline that says, zero shutters, ill-conceived 1% mortgage program. And I said, I think the smart money's on the extreme under on that prediction.
Yeah. Absolutely. Yeah. It's amazing how we don't learn anything, not on a personal level, business level, and especially, the government leads by example. Can I just touch base on a couple of things? I want to make sure I talk about banks and what's happening. I started.
Michael, we're here to touch on everything you want to touch on. So you drive, my friend.
Okay. So I started the show this time saying it's the recession in abeyance, held in abeyance, and not canceled. The yield curve has been inverted for 14 months, and it's been upside down. Now, I think the last time I looked was like 70 basis points. It was as high as 100 basis points inverted. But I want to just explain that this is a sign. It's not just a coincident indicator. Well, every time the yield curve inverts, we have a recession, or 99% of the time since 1945. It helps cause a recession because it puts banks under a lot of pressure, because their assets aren't earning what it takes for them to get their income, which is, their deposits, where they get their income from. So the net percentage of banks tightening lending standards is now 50.8%. That is an 82.3% percentage points change from the nadir where it was in March of 2021 till today.
Wow.
That is a net percentage change of banks tightening lending standards like we have never seen before. I'll add one more to that. The real Fed funds rate has gone from -8% to +2% and is heading higher. That is also one of the biggest trenchant moves higher in interest borrowing costs the overnight interbank lending rate we've ever seen before in the history of the Federal Reserve. So the pressure on the banking system is enormous. That's why we see M2 money supply contracting from its very high level now to contraction. His growth was phenomenal, like 40% in the period of time between 20 and 22, when we saw the Fed monetize $4.5 trillion of the $6 trillion worth of helicopter money deployed by the government. These are you say, like, what have we learned? We have learned to do exactly this wrong, stupid thing, but in exponential terms.
So we have unlearned at a faster and faster rate. Let me say, Michael, too, just give you kudos. I had Lacey Hunt on the program about a month ago or so, and he really drew a bead on exactly what you talked about there too, in terms of the banks tightening really at almost sort of an unprecedented scale in terms of the speed of it. And the title of the interview with him was Credit Crunch is now underway, where the banks are just they're not lending out nearly as much as they were, and it's going to get worse for all the reasons that you're intimating here. But to be in the same company as Lacey Hunt, I always think is a really safe and
you could do that
commendable
anytime.
place to be.
Absolutely.
All right, so I do want to get to the consumer real quick. Anything else to mention just on the government side of things about the impact, the lag effect, if you will, of these higher rates?
I think I said it all when I said by 2040 we're going to have no money left over to run the government other than Social Security, Medicare, Medicaid, and interest on expense. I mean, that's
right.
scary. That's scary. By the way, I want to parenthetically say, before I forget, that assumes that there is no recession between now and 2040.
Okay. What interest rate does it assume?
I think it's 4.5.
Okay, so lower than what we have right now,
yes,
right? So, because obviously, and we're going to get here in a little bit in the discussion, rates are highly likely not going to stay at this level. They're probably going to come down. Certainly, they'll come down. It's probably many times between now and 2040 for, if no other reason, just massive intervention on behalf of the Federal Reserve, its rescue efforts or whatnot. But we'll see how successful those are. I do want to ask you at some point, do you see more secularly high interest rates going forward than we've enjoyed for the past couple of decades? But I do think, and maybe we jump to this briefly at least, do you see lower interest rates at some point in the relatively near future? And by that, I mean 6 months to 2 years, as the Fed is forced to intervene as something truly breaks under these things?
So for every action, there's an equal and opposite reaction. And I believe the Fed will panic with reticence back towards ZERP and QE again. But the other side of that equation is why the Federal Reserve panics back to ZERP in an environment where he's 50%, he's off of his 2% inflation target. And that's because the economy and banking system is in meltdown mode. And that to me would mean, well, maybe your average interest rate, maybe, and I want to touch on this in a second. It's a perfect segue to what I want to go to next. But maybe the yield curve, the entire yield curve comes down. Maybe. I have my doubts on the long end, and I'm going to get to that in a second. But it's because the deficits explode into the multiple trillions due to that recession.
Okay, well, let's go there then, because this touches on a prediction that's been made on this channel a couple of times by Bill Fleckenstein, and I've had some people say I should get Bill on the program again soon. I'm going to, folks. Where Bill's big concern is that the Fed will be forced to pivot before it gets inflation fully under control. Pretty much exactly what you're saying.
Yeah.
And the bond market is going to say, you know what, Fed, I don't have any faith in you anymore that you're ever going to be able to contain inflation. And you're probably going to have to resort to these measures that caused us to have these massive deficits as far as the eye can see. And therefore, I want higher yields on the longer end of the curve to compensate me for that increased risk. Is that pretty much what you're saying?
Well, I've written extensively about exactly.
So there you go. Okay.
I mean, I've put it in writing many, many times many times in the past. That's exactly why. In fact, I wrote a book about it in 2012, that you're going to inculcate to the market that you have no control of your currency or your debt. And that's when the long end of the yield curve just goes bonkers. And look what's happening now. There's several reasons why I believe the long end of the yield curve is going to be a buy in the future. Talking about long duration treasury bonds. You think about the ETFs, TLT, ZROZ, zero coupon bonds, the longest duration of bonds. And I think there's 4 or 5 reasons why they're a no touch for me right now, though. Number one, you saw inflation come from 9% officially down to 3% headline CPI. So that's disinflation, which I called for would happen in 2022, 2023. So disinflation would occur. But that's now turned into more of a stagflation, or perhaps even what I predict, we're going to get a CPI print in a couple of days from this recording, which is being done on Tuesday, September 11th, which is a very solemn day. We didn't mention that, but it's
We haven't. You're right.
sad
We
day
should
for the
give nod to
country.
that.
Yeah. Our thoughts and prayers go up. Everyone affected by that tragedy. Now in the next few months, I predict headline inflation is going to drift towards 4%.
Got it. So sort of a reflation near term.
So disinflation is temporarily over. So that is putting pressure upward on the yield curve, because what is the yield curve? Who controls what part of it? The Fed controls the short end of it, because that competes with Fed funds. Short-term treasuries compete with the money markets. Long-term treasuries are more a reflection of the inflation expectations and growth expectations of the U.S. economy. So inflation is no longer disinflation now. It's kind of a reflation, as you so well put. That's number one. Now, amazingly, Adam, the Atlanta Fed has GDP growth for Q3 close to 6%. Now, I laugh. You're laughing. It's actually humorous. I don't know how you get there in an environment where productivity is floundering, and the population growth the labor force growth is 0.5%. It's a half percentage point. You just can't get there. Gross domestic income is negative. There's an earnings recession out there. I mean,
right. Unemployment's actually starting to move up. Right. It's just
tax receipts are down. So there's a lot of reasons why you should not believe 6% or anything close to that. But that's the narrative from the highly accurate Atlanta Fed. So you see inflation is stopped falling. You see growth is now accelerating. China is selling off of China and Japan are the biggest holders. Their reserves are parked in treasuries. Their currencies are floundering. The Chinese renminbi and the Japanese yen. They are selling off their holdings of treasuries to support their currencies.
Okay. So just to be clear for folks, when you hear about yield curve control, this is part of what's going on there.
Correct. That was my next point. So Japan
go ahead.
so Japan and China are selling treasuries to support their currencies. Also, Japan is selling treasuries because they're relaxing yield curve control. They no longer want to have that 10-year JGB. Now it's spiked to 70 basis points. In fact, there was Ueda, their central banker, was talking today about completely relaxing the yield curve control in Japan. If they did that, Japan would implode, and that's what I think the fourth largest economy on the planet. So that'll never happen. They can't just say, "Hey, we're the only buyer of Japanese government bonds." Japanese government debt is I think 1.4 quadrillion yen in debt. So they are in worse condition than the United States, and their inflation rate, if you look at the food inflation, it's 8%. So why in the world would anybody lock up a Japanese government bond, JGB, going out 10 years? Any private free market entity eschews them like the plague. So the only buyer is the BOJ, Bank of Japan.
The government, yeah.
And if they step away, you will see those rates go towards 10%, not 1%. So that's another reason. And there's one more reason, and to not buy long duration bonds right now, even though I'm getting ready to do so. I'm waiting for some things we'll talk about to become manifest, is the explosion in debt and deficits and the Fed's QT program. So when the Fed engages in quantitative tightening, what are they doing? They are pretty much it's the same process of selling. Instead of rolling over their treasuries, they allow them to expire and they say, okay, we have a bond due. Treasury says, we have a bond coming due. The Fed says, I have no money. The Treasury says, I have no money. So they go out to the private market and they sell a bond, and then they get that money and they pay back the Fed, and the Fed destroys that money. That's quantitative tightening. They're no longer a buyer. So you have 5 reasons why you should be very cautious about buying duration bonds until the recession becomes manifest. And that's going to mean you're going to need to see initial claims spike. You're going to need to see non-farm payrolls approach zero. We're not seeing that yet. So it's right now, it's a no touch for me. I'm not shorting them yet. I will in the future. I can guarantee you that after the next recession, after the Fed reliquefies the banking system. Right now, I'm just no touch.
Okay. So many great things that you've just said there. I want to dial into the QT and deficit spending for a second. So Janet Yellen just recently announced that the Treasury is going to be issuing something like 1.9 trillion worth of U.S. Treasury bonds over the remaining part of this year, which is really not that many months, right? So I imagine that's got to play into your math too, right? Where you have an increase in supply. Right. Fed is not there to just mop it all up because it's doing QT. So they're going to have to go out into this market of international buyers, well, all buyers, but a lot of the big buyers besides the Fed are in sell mode right now, like you said, right? So presumably yields will be going up on those. And
according to the Treasury's intentions, a lot of those treasuries are going to be sold on the long end of the yield curve because it's a lower interest rate for them. So they're locking in lower rates forever,
Okay, so I do want
supply pressures.
I do want to get to your arc of how you plan to hold these things, because my guess is you are holding them at arm's length right now, but you will be ready to pivot when the Fed pivots, more or less, or when you see some other triggers, and then you'll go long these guys for some period of time. Before we get to that, though, I do just want to round out the recession risk part of the discussion. So we've talked about the financial system, the banking system, the government. Let's talk about consumers for a moment. They are, well, housing buyers or anybody with an adjustable rate mortgage or anybody who wants to sell and then buy another house, they are struggling with much more expensive mortgages than most people, remember dealing with. Sure, those people who bought houses back in the 80s, can maybe still remember high mortgage rates, but different world back then. And then, we have a lot of factors. You've mentioned several of them, but that are giving increasing headwinds to consumers' ability to get ahead. And of course, the bottom 90% of consumers are the ones who have taken, the full brunt of the increase in cost of living that we've seen, resulting from all these pandemic stimulus campaigns that you've been railing about. And then we have a couple things coming up ahead, one of which just started a few days ago, which is student loans going back into repayment, right? So those loans are now officially, the clock is ticking. They now are actually accruing interest again. The first payments are going to have to be made in about 3 weeks from now. How big of a deal do you think that's going to be?
Listen, don't accuse me of being a Pollyanna, but I think it's going to be less. That is probably less of a big deal than many people talk about because of Biden's on-ramp program, where he basically told people, "Hey, listen, you don't have to pay your student loan. Don't pay it. For a year, you don't have to pay it because it'll be no harm to your credit rating whatsoever. You'll get no call from a collections agency. Your credit score will not be affected." I mean, what? So if if I had a student loan and I'm thinking, well, for 3 years I haven't paid anything, and now I mean, maybe Biden wins again and he finds a way to cancel this debt. My guess is 40% of the people with student loan debt don't pay it. So 60% have to start paying. So
that kind of measures with recent surveys where 45% to one survey response I saw said, well, I'm going to go delinquent if I have to repay because I can't repay it.
Yeah. And if you can't repay it and there's no repercussions, like no one's going to come after you. It's not going to hurt my credit rating. My credit score stays the same. I'm not going to go into collections. So why would I pay it? if I can.
Okay.
So I'm not going to, what am I going to take out some credit card debt? Listen, delinquencies on credit cards, consumer loans, and auto loans are already at a decade high. So this is before anybody pays their student loan, but on a rate of change basis, some people, some proportionality of the population that owes student loan debt is going to start repaying their loans. So that is a net negative. It's not a positive.
Right. And speaking of those other loans that they own, the ones that are revolving, meaning they have, floating rates, credit cards, for example, anyone taking out a new car loan, et cetera. Like these are the interest rates are either at, for credit cards for sure, or near record highs, auto loans, in terms of the interest rates that are being charged, right? So not only do we have a record total outstanding balance of consumer revolving credit, but it is at the highest interest that it has ever been at. It's the worst of both worlds.
That's why you see a lot of pressure on, especially the lower three quintiles of consumers. Listen, the real estate mortgage is frozen. Refis, that practice back in the aughts when they, said, hey, my house went up so much in price, and I'm going to refinance my mortgage and take money out, and my payment's going to stay the same, and because the rates were going down. I mean, that's over 30%. And mortgage purchase applications are down 28% year over year. That's a depression in housing activity. That's another reason why I'm like, 6% Atlanta Fed, 6%. Are you sure about that? Because I mean, how much income is generated from the transactions of real estate, from lawyers and brokers, selling a house and then
buy. I mean, it's carpenters and contractors, and I mean, just it's a massive contributor to the economy. Right?
Massive, and we're also seeing more. You want to talk a little more about the consumer pressure? There's a research firm called Challenger, Gray and Christmas.
Yeah,
layoffs this year are up 2%, 20%. No, they're up 210%. Planned layoff announcements are up 210%. From this period of time compared to a year ago. So you take the first 8 months of 23 compared to the first 8 months of 2022. Those are planned layoffs that haven't happened yet. So that's why I said it's recession delayed, it's held in abeyance, it's not canceled.
Okay. So, I keep using this term because it makes sense to me, which is just like this increased gravitational force, right? As cost of capital goes up, cost of debt goes up, and cost of living goes up. It's like someone is dialing up the force of gravity, and it just gets harder and harder to move forward. And I think more and more consumers can relate to that. And maybe we go into this territory in a little while, Michael. I think we are finally beginning to really see I think the buckling of the consumer household, the majority of that is still ahead of us, but I think we're really beginning to see people begin to get fed up enough that they're starting to sort of find their voice around this. And I don't know if you saw that song that became a #1 hit out of nowhere, "The Rich Men North of Richmond." I did a video on it. But to me, that's sort of a sign, sort of a fourth turning sign, as a nod to Neil Howe, that enough of the populace is sharing what Peter Atwater calls this shared hopelessness, this despair of shared hopelessness, where something like that can go incredibly viral in a heartbeat because it puts its finger on a wound. It actually finally gives voice to this emotional pain that people have been feeling. And once they have words and they can coalesce around a message or an anthem or whatever, then they can take action based off that. We've seen that happen in many other tumultuous times in history. So anyways, my point is I think we're just beginning to see some real social fracture lines begin to occur, because of this increasing struggle that folks are going through. All right. So go ahead.
You want me to comment on that real quick?
Yeah, jump in.
So, I think we can put to bed the myth that the Fed is there to protect the lower and middle classes of this country. And that's why it's so good to have programs like yours on, because people like me can expound about the fact that they are destroying this country. You can't have a viable nation without a vibrant middle class. It just doesn't work, Adam. And we had, according to official figures, we had a 9% inflation rate not too long ago, a little over a year ago. And that means that the purchasing power of the US dollar gets destroyed in half every 8 years.
And those are official figures, which we know are much rosier than the reality.
Listen, we know for a fact that home prices went up 43% in the last 2 years. That's from private sources, Case-Shiller home price index. So we know rents have gone up commensurate with that. So in reality, you're talking about 40%, and that means the purchasing power of the dollar gets cut in half about every 2 years, according to the rule of 72. So this is the room. This is why you're such a great channel. I can get on a soapbox here and expound on the fact that the Federal Reserve is destroying the very people they purport to care most about, which is the lower and middle classes. I mean, why do you continually tell us how, with the unemployment rate of this class and that ethnic group, you don't care about that. You care about keeping banks in business. And if you doubt what I just said, just look what they did in the middle of March of this year. Who did that really help the most? And why did they do it? Because they're in business to bail out banks, not the American people. They are destroying this country. They destroyed productivity, and they're destroying the purchasing power of our currency.
Yeah. And deliberate or not, and I think we can make a lot of arguments that it very well may be deliberate, but deliberate or not, their job is to support the banking system, right? And no huge surprise, because the Fed is a confederation of banks, right? I mean, it's taking care of its own to a certain extent, but it is in the business of rescuing and enriching them and all of the individuals who benefit from the output of the banking system, which is a relatively small cadre of people, and their wealth has just gargantuanly increased over the past couple of decades at the expense of the bottom 99%, right? So to your point, they really can make a very strong argument that they are just sacrificing the future prosperity of everybody but this top echelon.
America is supposed to be a meritocracy, and failure is part of that process. Some people fail. Leveraged people, leveraged entities, leveraged institutions, leveraged individuals, they have to be allowed to fail for the system to work. But this system of government that we have now does not believe in a meritocracy. It's becoming more and more of a socialist construct, unfortunately, and one that resembles a banana republic more and more. And I say that with someone who loves this country. It is becoming a banana republic. Just look what's happening in the political world. We haven't even talked about the election of 24, which could yank this country closer and closer to what I believe could be a partial civil war. And I don't espouse it. I would hate for it to happen. But look at countries that have a habit of arresting and putting to jail the previous administration. That doesn't happen in America. It never has, and it never should.
Yeah, and if you go to a banana republic, and I've been to a number of them, what describes it, right? It's basically a very small ruling elite that live exceptionally well, and they live in all these gated communities because the rest of the country is impoverished, and they're afraid of hey, if I go out in the real world, these people are going to, attack me, right? But it's this oligarchy, basically. And to your point, with our corporate cartels and everything, we seem to be getting further and further along in that direction. And I was just jumping in earlier because you're railing about what's going on here, and I just want to underscore, to try to head off some of the potential criticism, is you're not making a partisan comment here, right? This is something that has persisted under administrations on the left, on the right. It is just part of the power structure that we have right now.
Look, I mean, I'm a libertarian. Donald Trump increased the debt of this nation. far above where it needed to be to bail us out from COVID. And then Joe Biden took the baton and sprinted from there. So this is, you can criticize me if you want to. I say I'm a Trumpophile or anti-Biden. I'm a libertarian. I care about this country, and I'll just call him as I see him. I think Trump made a lot of mistakes, did a lot of things right. He made some very big mistakes. One of the big mistakes he made was constantly pestering Jerome Powell. Listen, we want negative nominal interest rates. He actually, pushed the Fed to try to go that route. Europe has got negative nominal rates. I want those too. He's the king.
Sorry to interrupt, but when he was campaigning, he was out there saying the Fed is blowing a bubble by keeping interest rates too low. And then, of course, when he's in the presidency seat, it's okay, hey, I want lower interest rates. So just wanted to point out the differential in his positions.
Well, I know it's a shock. It'll be revealed in this program first that there is hypocrisy in
politics.
Yeah. Okay.
Yeah. So anyways, I just wanted to make it clear, because sometimes people will cherry pick a point and say, oh, Michael's on one side of the political spectrum. I've known you to be very, libertarian minded, but also I think to be, very nonpartisan, very pragmatic, and very equal to cast aspersions on both sides when you see ill behavior. And sadly, I think you see a lot of ill behavior everywhere when you look at DC.
To your point, we're creating an aristocracy in this country. And it's because of the Treasury and because of the Federal Reserve and the politicians.
Okay. As much as we could spend the rest of our time on this, I gotta rest it back, because we still have to get to your model and how you plan to navigate where we are right now versus what you think is coming ahead. Last point on the recession side of the story. I think you've largely said this with your points here, but we talked about the financial system, the banking system, government, consumers. As consumer spending obviously gets increasingly compromised, we're still a 70% GDP consumer spending driven economy. That is, correct me if you disagree, that is likely to then eventually manifest this corporate earnings recession that we thought was going to happen earlier this year. That is going to then cause corporations to start laying off people as part of their cost-cutting measures. That is probably likely going to accelerate, create for some period of time a vicious cycle of diminished consumer spending. That may cause the breakage in the system. The breakage in the system might happen before. It may come somewhere else, like it started in the banking system, right? But at some point, we're going to enter recession. We're going to have these vicious cycles. Something's going to break. And then we get to a decision point for the Fed. Do you agree with everything I just lined up there? And if not, clarify for us.
No, I certainly do. You fantastically said. Congratulations. The pandemic-related savings is scheduled by many sources to run out in Q4 of this year. And then you add to that the fact that the banks have stopped lending and the real estate market's in a depression as far as transactions are concerned. I didn't say depression in prices yet. I said transactions. That should lead to a fall in asset prices in general. It should lead to a fall in consumption. It should lead to a fall in the stock market. It should lead to a fall in home prices. Don't forget, you have people say, well, you have better underwriting standards, and I definitely agree with that, with the exception of Zillow. But when you have 20 to 25% of homes, single family homes in this country owned by investors and Wall Street, I put myself in the mindset of Blackstone, and I say, okay, so the zombie companies start laying off people, and when the corporate debt gets reset in 24, and they're paying much more higher interest rate, corporations start laying off people, unemployment rate rises, my income stream from these rentals starts to dry up, home prices start to roll over a little bit, and I'm sitting on a 43% gain in my home, that investment speculative property that I purchased a few years ago. I'm going to sell it. I'm going to I think there's a huge shadow inventory that can come and hit the market once we start to seeing that dynamic I just laid out play out. And
so I've been talking about this a lot. So I'm so glad to hear you say this.
So you have someone coming on your conference I think his name is Gurley.
Yeah,
I think
Nick
he's
Gurley.
fantastic.
Nick Gurley.
I think Nick is fantastic. I hope he has a lot to say about what I just said.
Thanks. Oh, he certainly will. So having talked to Nick, having talked to other folks like Amy Nixon and Melody Wright, who are also tracking a lot of what's going on in the housing inventory side, they all think that inventory is going to increase at a much faster rate than the market currently expects. And this topic, which I don't have the time to get into it the way I'd like to with you, Michael, because I really have a strong aversion to the dramatic increase in institutional ownership of single-family homes in this country. I don't think there is any real societal good that comes out of institutional ownership of homes that otherwise a citizen of this country should be buying to live in, right? And there's a whole bunch of reasons we can get into around that, but one is exactly what you put your finger on. I've been trying to raise this warning flag for folks, which is these corporations live in zero of these houses, right? And these corporations, to them, it's just business. And if you get into, a position where you're starting to lose cash flow, you can say, all right, you know what, we're going to shutter that division, or we're going to get out of that market, right? And bang, hundreds of units, maybe thousands of units in certain metropolitan areas could suddenly flood the market, right? It just creates this much greater market instability that I think any of the regulators, national or local, who have been happy to get all the transaction revenue from this have thought of.
Well, you probably didn't show me when you were saying that, because I almost jumped out of my chair. In fact, I blew you a kiss. I don't know if it got.
Yeah, right.
I mean, you said it is beautifully said, Adam. And people will blame unbridled capitalism. But that has nothing to do with it. It all lands at the feet of the Fed. Blackstone wouldn't be taking out all of these mortgages and buying tracts of single-family homes across the southern tier of this country. 25%. I mean, just think about that. It's unprecedented and unbelievable. They wouldn't be able to do it. They wouldn't be incentivized to do it if money wasn't free.
Right. And the fact
that's not their fault. That's Powell's fault.
Right. We're providing what I call, we all hear about malinvestment, right? I think that in many cases over the past couple of decades in many different areas, but certainly in this one, we have provided a malincentive, right? We have provided a perverse incentive for this behavior to happen, right? We're creating the incentive for it to happen, but it doesn't serve our national benefit, right? So anyways, we're going to learn this story, our lesson on this one the hard way, it sounds like. But anyway, so it does sound, Michael, that for this reason and perhaps many others, you think this sort of frozen condition we have in the U.S. residential housing market will more likely than not resolve in lower prices ahead.
Yeah, it'll unfreeze, but you're not going to like the process. There's going to be you're going to get frostbite as it unfreezes, because you're going to see a lot of homes come on the market. Blackstone is going to be unloading their hoard of single family homes when home prices stop going up and it's no longer making any sense for their balance sheet to hold them.
Okay,
Blackstone et al. I'm not going to blame just Blackstone, but et al.
Yeah. And folks, I'm going to make the transition in just a second to, okay, so what do we do about all this? Because I know that that's what's on everybody's mind. And Michael was a fantastic guy to really dig deep into that with. Just a point I want to make on this before we leave, which is, right now it is the most unaffordable time to buy a home in the U.S., right? You've got the combination of high prices that haven't corrected materially yet, and high mortgages, right? It's just the worst time ever for somebody to go out and buy a house, which is why, we're beginning to see so many fewer transactions, because so many buyers just can't do it. Even if they want to, they can't qualify. But another thing is we've had over the past couple of years, decade or so, we've had this explosion in, all cash buyers, right? Who come in and just say, okay, I don't need contingencies, and it's just here, it's all cash. And a lot of that's been the corporate buyer. And one of the really unfair parts about this institutional ownership, why I think in many ways it's kind of immoral, is because it's not a level playing field, right? These guys have much deeper pockets to begin with, but they can borrow at much cheaper rates than the average consumer can, right? So it's just not a fair fight. And these guys just come in with their, their ability to borrow at ridiculously low rates relative to consumers and their big, investor deep pockets and say, great, I'll just take that thing in cash, right? So the consumer, the aspiring resident always gets the short end of the stick. One last point on this is I was talking to a realtor this weekend. I was at an event. The realtor was checking their phone because they had a transaction going through. And they specialize in like, $3 to $5 million plus dollar value homes in San Francisco. And this was a no contingency, all cash offer. And I was asking, like, who is still making these decisions right now? And it's actually not so much the institutions anymore. A lot of them have stopped buying in this market because, to your point, they're now beginning to realize that maybe they're getting into trouble here, right? But he said at this point, it's just old money. And there's nothing wrong with that. But it back to your point about it kind of being like an oligarchy and whatnot right now, it seems like, unless you have a massive unfair advantage, you're an institution or you have the backing of generational family wealth, it's harder and harder to get by, even with the basics of like just buying a place to have a roof over your head with.
She's made so many good points there. I don't want to take too much time. They'll just say Powell takes interest rate to zero, creates a bubble in AI stocks, and you sell those stocks and you buy a bunch of houses. And Blackstone taps the corporate credit market at the lowest rates. The spreads can't pancake to zero because of Powell takes away all risk. And they go out and buy a bunch of properties and they say, I'm doing humankind a great service because I'm putting homes that are available to rent to people who would otherwise not be able to rent them. That was the line that you heard from Blackstone. Never mind the fact that these rents are going through the roof because home prices are flying. And even in July, so the latest read on Case-Shiller was July, home prices started to tick up again a little bit, had a little slight tick up. So got a lot of work to do on that front before you unfreeze the housing market. It's coming, but like I said, you're going to get frostbite.
Well, and look, I mean, we can only hope whatever happens, it's going to be painful. So, I mean, that's going to be the hard truth. If indeed what you think, it happens, it's going to be painful. We can only hope it becomes at least a little bit more equitable. Who knows? But to your point there about, the policy that then creates the ability of the deep pocketed to then buy the homes and then rent them out. I mean, you remember the old company stores of a century ago, right? Where people, lived in a town that was basically owned by a company and they were basically perpetual serfs, right? To the person that they worked for, because they owned everything and you basically had to kind of rent everything in the town, right? We are becoming a company nation. If this trend continues. And sadly, there's been recently a bill that's been proposed in Congress to sort of raise this issue. To my knowledge, it hasn't gone very far yet, and probably won't in this initial incarnation of it. But beyond that, there's just not a lot of dialogue going on about this yet. And so obviously you can't fix a problem if you haven't admitted it yet, but hopefully maybe we're in the early innings. I don't know, we'll see. All right, but now main event, Michael. We've talked about all the challenges here. Your primary thesis, you've laid it on the table. The recession has been delayed, but it hasn't been repealed. It is coming. It's highly likely, to come for all the reasons you've highlighted here. You have got your proprietary model. If you wouldn't mind giving just 30-second refresher for folks on kind of how it's constructed, and then talk about how you're positioned now, pre the breakage happening and the policy reversal and all that stuff, and then how you plan to react to the breakage.
Okay. So I've created something called the inflation deflation economic cycle model. It's a 20-point model. It's a diffusion index, and it's based on the second derivative, or the rate of change of inflation and growth, 20 components. So, and I thank God for this model.
Our interview with Michael will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. Also, don't forget that tickets for the Wealthion Fall Conference are still on sale at the early bird price discount of nearly 30% off the standard price. And alumni of our previous conferences get an additional 15% discount on top of that. To lock in these low prices while they last, go to wealthion.com/conference. And if the challenges Michael has detailed in this interview have you feeling a little vulnerable about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends, risks, and opportunities that Michael's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Michael Pento.